Welcome to Make It Last, helping you keep your legal ducks in a row and your nest egg secure, with your host, Victor Medina, an estate planning and elder law attorney and certified financial planner.
Hey everybody, welcome back to Make It Last. I'm your host, Victor Medina. I'm so glad you could join us here this Saturday morning. I am excited to be here for this show. I'm going to be talking about a brand new concept called BitCoin. You might be hearing a lot about it in the news. I'm going to tell you what it's all about, kind of give you the skinny on that. And then we are going to be covering some new rules about Medicare contribution rates, because they could be going up next year. And depending on how much you make, that determines how much you're going to be paying in Medicare. So it's a good one to listen to. But before we get started, I did want to talk a little bit about some recent news that had come out. Now, you faithful listeners of the Make It Last show know how much I harp on the concept of having a fiduciary be the person that helps you with all of your investment advice and how you do your financial planning, because those are the only people that are looking out for your best interests. If you work with somebody that's one of the big wirehouses, they are just brokers. And by definition, their loyalty is to the company. They are registered representatives of the company. They represent the company. They do not represent you. So you want to be working with somebody who is a fiduciary. Now, on June 9th of this year, 2017, the Department of Labor had a set of rules go in effect that would essentially make it required that someone be a fiduciary if they are advising you on your retirement account. Again, this is old news for all of those people that have been listening from the very beginning. But if you're just joining us, hey, that's what the law is right now. And when we passed that law in June, or the regulations from the Department of Labor in June, they came with a kind of like a ramp-up period. Between June and January, they were going to have one set of rules before they had the final set of rules. And the final set of rules essentially made it a lot harder for people to sell you something that was conflicted advice, that something wasn't in your best interest. More importantly, it was a lot harder for them to sell you something where they got paid more to sell you that versus another investment. And so we thought, well, we're going to sit tight between June and January. And then after that, we'll have the good rules in place. And at least the people who are having their retirement money will have some avenue of recourse if they get, kind of hosed on this, because they can sue under class action. And anyway, we're going to have the right rules come into place. But wouldn't you know it? In fact, we have a delay of the rules. That's the new news. That what we have today from June 9th that was supposed to end in January has now been extended another 18 months, another year and a half, before the final rules are deemed to be the law of the land. And the reason why that's problematic is that if you think about what it takes for you to open up an account and do investments, when you're working with an advisor, just think about opening a bank account. There are all of these forms that get kind of spit out of the machine. And then you're just told and pointed, sign here, and then sign here, and then sign here. And then you ask them, well, what's this form for? And they tell you, well, this is to open the account. This means that we can mail you something at your home. This means that we can look at your stuff online. This means that you can look at it online. They can give you all kinds of, but you don't sit there and you don't read it. You just print it out. Oh, how many signatures do I have? Can I be done yet and just go home? And so right now, when the kind of like the fiduciary rule light, the one that's not really the important one, you can basically paper your way out of conflicted advice, because under a rule called PT 8424, what it says you can do is, as long as you advise somebody of the compensation that you're getting in the document, and you kind of let them know that you're going to be paid something more than if you gave something different advice, or that you're receiving some sort of benefit. A lot of these insurance agents, they're getting free trips to Hawaii and stuff like that for selling you certain level of product with a particular carrier. So anyway, if they just tell you that on a piece of paper and then you sign it, then that's good enough. That they didn't actually have to act in your best interest. They just kind of had to say that they did, and then they sign off with this little piece of paper. And so that's been the law since June, is that you can kind of get around this new fiduciary rule if you just use the paper that says, just kind of let you know what I got paid. And then that's what's going to continue to happen for the next 18 months. And so the consumer protections that were contemplated by putting in this fiduciary rule, they're not there. They don't exist, and they're not going to exist for another 18 months. And, this doesn't bother me in terms of my practice and what I do with my clients, because we've always acted like a fiduciary. It's what a lawyer is all the time. And my clients are never really worried that I'm not acting as a fiduciary. But this is a radio show where I'm trying to spread the information wide, and most of the people aren't going to listen to my show. I would love to say that I get the kind of ratings that the biggest shows do. They don't, right? Local show, we got a handful of listeners. And so we're not going to be able to spread this information very wide, and people are going to continue to be susceptible to getting hosed under this old rule. Because the fiduciary rule not only had this as a problem, but it also had the fact that it only applied to money that you were dealing with in your retirement. And if you weren't dealing with the money in the retirement, then they could still sell you anything they wanted for any reason. The little protection that we thought we had was coming in this fiduciary rule. And even though we weren't going to get the full-blown rule, because I don't know if you remember, but it was supposed to be a full-blown rule in April. Well, then what they said is they're going to give you the rule, but it's going to be the light version of the rule, and that's going to start in June. But then the real version of the rule is going to come in January. And here we come again, and now we're going to have to wait another 18 months before we're able to get the good rule in place. And people have no idea. I mean, if you were paying attention in June, it was a blip on the radar for the news and then gone again. And, it's the same old. I'm sitting here, reviewing clients' statements, and they ask in second opinion, hey, what do you think about this? And I'm reviewing real estate investment trusts. These are closed-end investments that are locked up, which I know pay an enormous amount of commissions to the people that sell it, but which have no real need in somebody's portfolio. The only reason why they're there is essentially because they pay a lot of commissions. There's a report that came out about a certain investment product that just plummeted by 84%. 84%, right? Fewer use of these closed-end products because they could see on the horizon that they weren't going to be something that they could use going forward. And so for that reason, they stopped being sold. And that just tells you that was the bad investment from the beginning. It only existed to pay the financial advisor, and it didn't exist to serve the client, which is why that since there's a rule that says you have to serve the client, they stop selling them, and it goes down. But it's still in place. You look at these really expensive portfolios where they can share in the 12B1 fees as part of their compensation, and you say, why are they here? I was reviewing there's a couple of set of options for a client and trying to give them investment advice about what to do in their company 401k. It's nothing that we could manage. It was something that they had to go with their company, but they're coming to us for advice, and we say, okay, well, here's what we can do for you for this other stuff that you have, but for your company, let me take a look at your investments, your options, and I'll tell you what you should invest in. And we essentially had two target date funds. Target date funds are basically funds that are managed by somebody, and you take all the thought away and you say, look, I'm going to retire in the year 2050, and just manage it like I'm going to be retiring in 2050. It's just one single fund. And so you had two of them that were both key to the year 2050. One of them had an expense ratio of 0.25% a year, so 0.25. The other one had an expense ratio of 1.25, a full percentage difference. And there's arguably no strategically different value for one over the other, except for this. The one that charged more in fees was the one that shared those fees with the advisor, and the advisor got a little kickback for putting you in that. And that was in there as an option. So obviously we chose the cheaper one, but that just gives you an example. It's still there. Folks, you've got to be vigilant about this. You've got to be asking about expense ratios. You've got to ask about compensation. You've got to ask people, are they getting compensated by someplace other than you and your money? And what is that? And all of those things get jumbled together because it's clear that the regulations aren't going to be there to protect you. And so you've got to protect yourself. All right, that was the rant for the first one. Thanks for indulging that. Listen, when we come back, we're going to talk a little bit about BitCoin, and then I'm going to talk to you about Medicare reimbursement rates or premium rates, and then that'll be it for the show. We will have 30 minutes flown by, so stick with us. We'll be right back on Make It Last.
Just about every working American stays focused on the ultimate goal, retirement. But planning for it can come with a lot of uncertainty. Do I have adequate savings? Have I invested enough? Have I invested too much? What's the right thing to do? If you're one of the millions of Americans asking these questions, let financial expert Victor Medina help you make sense of it all. Victor is a certified financial planner and retirement income specialist who can help you set the strategy with a unique planning process that centers on you. By taking an in-depth look at your retirement timeline, goals you want to achieve, and what you have saved, Victor and his staff can help you figure out how to get the most out of retirement. Retirement is the biggest financial decision you will make. Putting the right plan in place and sticking to it is the smartest decision anyone can ever make. To learn more, visit Private Client Capital Group online at privateclientcapitalgroup.com and start down the path of securing your total wealth today.
All right, well, welcome back to Make It Last. I've ranted about fiduciary, which seems to be like if you're playing the drinking game at home, bingo. If Medina mentions fiduciary, that's like the center square. Everyone gets that one for free. I want to talk to you about a newer sort of kind of investment, or what people are considering investment, is Bitcoin. And it's sexy and it's on the news and people are talking about it. Bitcoin hit 10,000 and it hit 11,000 right after it hit 9,000. And oh my goodness, where could it go? Where could it go? Where could it go? And so I thought it might be important to kind of talk a little bit about what Bitcoin is and have you kind of understand that, and then talk a little bit about whether or not it is whether or not it is an investment that is something that you should be considering. And so let's first start with trying to figure out what Bitcoin is. Bitcoin is essentially a form of a cryptocurrency. Now, a cryptocurrency is a currency that is not issued by a particular country. And so it doesn't have the backing of a company. And that's the way most currency works, right? Most currency, the dollar and the value of the dollar is backed up by the strength of the promise of the United States government to pay. If you present a dollar, right, a dollar's worth of something in there, it's tender. It is a promise by that country. And so most currencies are linked to countries. But this Bitcoin is a cryptocurrency, and it is a currency that essentially has no country. It kind of exists. Now, if it has no country, then that question becomes, well, how do we determine its integrity? How do we know that the value of a Bitcoin is in fact something that is worth what we say it is, or that if you are the holder of a Bitcoin, you have someone has the confidence that what you're presenting to them is in fact enough Bitcoins of whatever it says it is. Because the Bitcoin is essentially this currency. It's used online as something to pay for something else. And so you can send somebody Bitcoins and then they'll send you a package in the mail. Now, cryptocurrencies have long been used by, kind of bad hombres, bad folks, because they will be selling drugs and paid for it, black market stuff. But it has gained more and more acceptance over the time, where even there's banks now that will allow you to pay in Bitcoin, because Bitcoin has got sort of a legitimate value, outside of sort of the black market of what it's used for. Now, Bitcoin has been growing in value in large part because of the scarcity of it. And so it's worth more and more if you hold on to it, because people want it. People want the currency, they want to be able to use it, but there isn't a lot of it available. Now, to understand how it's sort of made, Bitcoin is essentially something that is mined, okay, like a jewel, right? It's mined, and it's mined using your computing cycles. And so essentially what you do is you give over your computer's ability to do computations, and you sit there and let it run computations. And if you do that long enough, you mine Bitcoins that will allow you to get it. And so that's one way for you to create new Bitcoins, is to essentially mine them, is to give over your computing cycles so that you can, they'll give you a Bitcoin if you do that enough. Now, there's an algorithm that makes it harder and harder to get new Bitcoins. And the algorithm is actually linked to the integrity of the value of the Bitcoin, because what happens is that it relies on technology called blockchain. And so blockchain is essentially a set of technologies that kind of guarantees integrity, because each one of its kind of made up parts is dependent on other parts that have to be checked back in with the part that created it. So now let's explain that in a way that might make a little bit more sense. But if you are somebody that held onto one piece of the code, you can now verify that if somebody presents to you this middle part and it's the same as you hold, you can say, yeah, that's right. That's actually the code. And so when you add them all together, you essentially get a snapshot of something that you can absolutely guarantee was the thing that it's saying that it is. And if it isn't, right? You can reject it. And so it's very hard to, some would say it's mathematically impossible to present a Bitcoin that is false because it just won't register as that. And so this idea of the blockchain is the computing cycles that it takes in order for you to kind of backtrack the little parts in there to make sure that you verify that what it is in fact what it says it is. And so the security of that is, and the length of the time of the securities is part of the reason why, one, the chain is reason why it's so secure, but also why it's slow. Okay, it's slow. And in fact, one of the things is that makes it one of the elements of the security is that they limit the number of the transactions that can happen in a day. So sometimes it takes days to complete a simple transaction of processing Bitcoins because you limit the number of it, and there's so many that you need to make. Okay, and so because of that, this idea of a currency, it's challenged a little bit. You challenge the notion that it's a currency because a currency usually means that you can use the money very quickly to replace something of value, to show value so that something, you can go and buy something and people can make a very quick decision as to whether or not they're going to sell you that because they can see it immediately and process the transaction very quickly. So the convenience of it is one of the reasons why a currency is what it is. It's why we don't barter. It's why you don't go look at, if you're going to, if I've got legal services to give, and I need my money to buy groceries, I don't bring my groceries. So, I don't bring my legal services to the grocery store and say, I'll trade these two, right? The barter of that is too removed for it. And so that's one of the reasons why, we invented currencies in the first place. We went from metal, it was written down on metal, and then we went to paper, and from paper to plastic, and from plastic now to electronic bits. And by the way, that's really all money is these days. It's electronic bits. It's not Bitcoin, but, you look at an account and it has your money in there, and all you're seeing is an electronic representation of what your money is. So this idea that it's a currency is a little bit concept challenged because it's not something that we can use very quickly by its nature. Its set of transactions is super slow. All right, so that was great, Medina. Thank you so much for the education. But just tell me at the end of the day, is it something that we should buy? Okay, and so if we think that it's not money that we can use, so if it's not a currency, then we got to think about it like an asset. And if it's an asset, we have to figure out, is it something that is subject to intellectual rigor about what we can expect it to do, or is it speculation? Okay, because if it's something that has some rigor to it, the way you can invest in small cap companies, because they tend to be more profitable over time, because their growth trajectory is preferable to, so for all of those reasons, right? If you can apply math to it to get a model that gives you some reliability, then perhaps it's worth something investing in. But typically something that is speculative is not a wise investment. Right? No matter what you read in the news, you don't buy a piece of art as an investment because you're speculating about whether or not it's going to increase in value. You have no model that says that it absolutely will. And so the moment that we now understand that Bitcoin is a speculative investment on an asset value that we cannot subject to any intellectual rigor, it comes off the table as something that we should invest in. Right? And for that same reason, we don't hold currency for the sake of currency as an investment. We hold currency as a hedge of your ability to buy something in the future, but you're going to be using it to buy, right? You're not going to be holding on to it like you would jewelry, in the speculative hope that it's going to increase. You don't do that. And so you wouldn't do that with Bitcoin either. So that's the wrap up. All right. So I hope that has been informative for you in a way that you kind of understand this concept of Bitcoin. By the way, Bitcoin is one of kind of 4 major cryptocurrencies. It's the one that's grown the fastest. It's the one that's the original. But I'm investing in none of them. Zero. Not a chance. Not a chance. If I want to go gamble, I actually go to the casino and then they'll comp me a steak, and then maybe I'll feel like I paid for my steak with my gambling. All right, and listen, when we come back, we're going to talk about new Medicare rules, new limitations that have come up, and we'll cover those because they are going to affect how much you pay Medicare premium. And so we'll hit that when we come back from the break. This has been Make It Last, and we'll be right back.
As you get older, there are so many decisions to make around your legal, financial, and tax planning needs. Searching for the right people who you can trust and getting them all on the same page can be frustrating and exhausting. Turns out, now there's a better way. Medina Law Group is the only place where you can secure your total wealth with a one-stop shop for your estate, retirement, and tax planning needs. With over 15 years of experience and more financial credentials than you can shake a stick at, Victor Medina and his team offer a way to cover all of your planning needs under one roof. Whether you're concerned about getting your ducks in a row or securing your nest egg or both, Medina Law Group can give you the peace of mind you deserve to make sure you have all the angles covered with best-in-class planning. Call the experienced professionals at Medina Law Group at 609-818-0068 to learn more, including your chance to schedule a free consultation. You can also visit MedinaLawGroup.com to learn more about protecting your assets and the Medina Law Group team. For peace of mind and a solid foundation, contact Medina Law Group today.
All right, welcome back to Make It Last. First segment, we talked about the fiduciary rule again. We just talked about Bitcoin, but now we're going to talk about your Medicare premiums and why the government might be having you pay more for Medicare this year versus last year. And so what I want to do is talk a little bit about how Medicare premiums are calculated, because most people are surprised to learn that it is done on the basis of your income, and it's done actually on a basis of your income in the past, and those numbers are not static. They don't change. So I got to give you a couple of terms in order to be on the same page. There was a law passed in 2003, and it's called the Medicare Modernization Act. Beginning in 2007, people who make a lot of income and who are in Medicare pay something called an income-related monthly adjustment amount, or IRMA. And these are surcharges to the Medicare Part B premium, which lifts the premium from covering just 25% of costs to up as high as 80% of results, and increases the Medicare premiums by as much as 219%. Okay. Now, since 2011, a similar charge has been applied to your Part D premiums. Okay, and so they'll increase a surcharge. You can get as much as the highest level. There's $914 per year in 2017. So the way that this works is this. The basic formula for it is that if you start to pay, make more than about $85,000 a year as a single individual, you move from paying 25% of your Medicare Part B premium to 35%. Okay, and then it goes up to 80% once you exceed $214,000 of what's known as modified AGI. Now that's important because most people are aware that their taxes are owed on the basis of their adjusted gross income, or just AGI. But there's a bigger number a little further up on the tax filing called modified AGI, and that number actually determines how much of your Medicare premiums you will owe, like how much you're going to owe in Medicare premiums. And they do that not on the basis of your income of the prior year, but they go back 2 years to that, 2 years. And so that's been in place now for a couple of years. Just to give you an idea, for 2017, if you were a single individual and you made less than $85,000, your Medicare Part B premium was $134. Okay, and your Part D premium was whatever the plan premium was. You know that you can do that every year. We did in a prior show, we talked about Medicare open enrollment, and you told you can select amongst different Medicare Part D plans. So whatever that premium is, if you make less than $85,000, that's what you pay. But if you make between $85,000 and $107,000, your Medicare Part B premium goes from $134 to about $190. Plus, you pay an extra $13 per month for your Medicare Part D. So you're going to pay $66 more per month, or almost $750 for the year. If you're between $107 and $160, okay, you'll pay an additional $133. So your Medicare Part B premium is actually going to be $270 or so, plus an extra $34 for Part D. And then it goes up from $160 to $214, and then from $214 up. Now, I gave you all the single numbers, but realize that the married joint modified adjusted gross income, is basically double all of those, because the Medicare Part B premium is actually part per person, right? So if you're in Social Security, you're paying your $134 per person. And so if one person's incomes, drives you up above that, 107 or the 214 number, and you have to pay $190 a month, you're going to do that per person, okay? And so, as I said before, Medicare does instead of the prior year, it's the prior year income, okay, for that. And so for 2018, your Medicare Part B and D premium is going to be determined by the taxes owed on your 2016 year, okay, which you filed in 2017. So you filed it in 2017, you filed it this year, it's for 2016's year, and essentially it will be what you have to pay for the coming next year. Now, what ends up happening is that when we moved from 2017 to 2018, the tiers have changed for when you move from one to the other. We're still at a point in time where if you make less than $85,000 per year, you have to pay, just the plan premium. But we dropped down the next tier after that. So if you make now $133,000, you're now in the next tier that owes essentially $270 a month in Medicare Part Premium, and that is down from $160 per person. So we cut it we cut a little chunk into that, and we got to the higher tier faster. In fact, if you make $160,000 a year, you go to owing almost $350 per month in Medicare Part Premium, whereas last year you only owed $270. You're up to $350. And so that's a rule change that's coming in, which is going to affect a lot of people, especially people who are relying on this income to live. They're in that $150,000 range. And all of a sudden, because they've tripped from 133 to 160, and now remember, that's a modified AGI. That's not the end number. Because they've slipped into that, they're essentially going to owe more in Medicare premiums. So this is a big deal, right? And it's a deal that you probably weren't aware of when you were setting up and managing your income in 2016. But now that you know that it's a prior year rule, we ought to be thinking about how you're managing your income every year, especially if it's going to determine your Medicare premium later. If these thresholds continue to get changed and adjusted, it could significantly impact your cash flow if all of a sudden you have to pay 2 or 3 times as much in Medicare premiums as you did the year before. And so this just goes a long way into that concept that I introduced many, many moons ago that's there in my book called Proactive Income Tax Planning. Okay, the concept's called Proactive Income Tax Planning. The book is not, because no one would buy a book called Proactive Income Tax Planning. But in the book, Make It Last, ensuring your nest egg is around as long as you are, there's chapter 5, and chapter 5 talks about proactive income tax planning and how you can manage your income taxes proactively to avoid problems like this. Okay. And so that's a good note to leave on, is that you should be thinking about your income, and you should be thinking about how to manage your income so that you can make sure that you don't run across one of these problems when it comes to your Medicare premiums later, because that can really affect your cash flow. All right, so that's our show for today. I want to thank you. We hit a lot of hard topics. I had my fiduciary rant. I taught you all about Bitcoin. Now you can sound hip in front of your grandkids. And then now I taught you about your Medicare premiums. And then you're not going to talk about that at all to your grandkids, because that would make you tragically unhip. But hopefully you stayed with us through the whole time and you found something valuable. If you have, please do us a favor. We would really appreciate if you took this show and shared it with friends, took it with people that you know that could benefit from listening to this, and increase our listenership, increase it beyond our reach, and say this is something you ought to listen to. And we see those numbers continue to climb, so we know that you're doing it, and we just want to thank you for that and ask you to continue to do it. If you have any ideas for show topics, you can always send them to feedback@makeitlastradio.com. You can email us, contact us at Medina Law Group. Let me know what you think. Other than that, I want to thank you for joining us, and we tell you we're here every Saturday. We'll join you again next Saturday, or you can subscribe on iTunes and get it anytime that you want. Just search for Make It Last, download the podcast, and we'll have it automatically delivered to your phone. This has been Make It Last. We help you keep your legal ducks in a row and your financial nest egg secure. We'll catch you next Saturday. Bye-bye.
The foregoing content reflects the opinions of Medina Law Group, LLC, and Private Client Capital Group, LLC, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal strategy. There is no guarantee that the strategies, statements, opinions, or forecasts provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs.